So it's either the investment banks that are moving it themselves, the commercial banks that are moving it themselves. Okay, folks, tons to cover. We're going to start here with Tesla, and then we're going to get into the Fed and the indexes, so stay to the end. Now, I just want to point this out. We saw the indexes and how they took out a lower low today. We all saw that, I'm sure. Let's just refresh your memory. Here we are, breaking down pretty clean right there, right? So we know that that's happening, but let's take a look at what that means. It means that you should be looking for stocks that aren't taking out those lower lows. Why? Because that means one of two things. If we go weaker, these are going to take out the lower lows. If we rally, these are going to be the names that are going to go higher. Now, this was a really tough one to play today. I did a bunch of trades in this today, and frankly, the one that finally worked was the one at the end. And I'm just going to give you a heads up. We were looking at this in the trading room, and these are the ones that are working. So you're getting to the tops of these levels of where you were previously 2 days ago on the 13th. Well, actually yesterday. And then what you're seeing is you're seeing those levels tested. And this is a classic evening star pattern. If you're not familiar with that, I'm going to link that video at the end. But you're seeing that you rally up. The simple enough trade, short it right here. This becomes your stop. You can't get a better stop. Comes back down. Whether or not you closed is obviously up to you. But from that move down, there was about 20 points there. 25 points. That's really what you're getting in this market, why we're waiting for the Fed to decide what they're going to do. But start looking for stocks like this. Start compiling a list and get ready for tomorrow. And I'll go through that in detail and what I think you need to look at. But you know, if you see weakness, look for names like TZA. This closed at another high after rallying all the way up to 49 before selling down today. And you saw a lot of that coming in today, right? Why did we see that? Because people don't really want to be too long or too short going into the Fed. We just don't know what they're going to do. So we just need to kind of keep that in mind. But this should be on your radar, 3X bear fund. Reason being, nothing is more affected, no index is more affected by yields than IWM. TZA is 3X IWM on the bear side. I think we should probably go over this energy and what's going on out there. So, you know, everything needs to crack, right? If we crack, everything needs to crack. Then let me just throw this in so you can see the 50-day. As long as you're holding the 50-day, I'm okay. But if we're going to crack, everything is going to crack. So watch energy and watch these names. We started seeing signs of it today, and today's going to be a little different because I want you to see what's going on out there. This could be the tail end and the last leg down of the index move. Why am I saying that? Nobody knows for sure, but why is it a possibility? It's a possibility because you're seeing the last bastion of holdouts crack. Okay, you're seeing these kinds of trusts completely break down where they weren't breaking down before. SJT's breaking down. We've seen these moves. BPT tried to break, is still holding our level in here. You know, this is like a fan favorite we've been playing for a while. But even the big names that have the big money behind them, like Oxy, we know that there's a bid in this because Buffett has been buying it. But look at how we were unable to get above that 50-day. And I'd be really careful of these kinds of names, and I wouldn't be chasing them right now. But I think overall, there's more that you need to be looking at. So to start with, I think we need to be looking at the junk. I really want you to focus on what the bond market's going to do tomorrow, okay? And there's a reason for that. The bond market's going to move first. No matter what the Fed does, the bond market still always moves first. And that direction is not knee-jerk. From those that are newer traders, you'll notice how you're knee-jerked in the indexes ahead of time. Bond market's not going to knee-jerk you. It can't knee-jerk you. The market's too big. The players are too big. It's not retail that's moving the high-yield bond market or the corporate bond market. It's institutions and commercials that are moving that, right? So it's either the investment banks that are moving it themselves, the commercial banks that are moving it themselves. They're not going to try to play games. They're going to make a move. So what do we have here? We have a doji. Pretty interesting, right? So then if we just kind of look at, maybe we could see something, maybe if there's something that's oversold that we should be paying attention to, like RSI, and maybe that's below 30. Maybe this is something we should be paying attention to. One of the other videos that we went over ad nauseum was we talked about excessive volume to the downside and how that can be selling exhaustion. And this is junk. And now that everybody is looking at this, where are we a year and a half in? Well, that's the highest volume we've ever had. Maybe it makes sense to kind of drill into that and see if that's a spike. Well, when was the last time we were this high? Well, we had it here once, and then if we go back far enough, we don't have it till back here, which started to mark the bottom. So when you see signs like this, just pay attention. Doesn't mean you have to do anything with it, but also remember how this works in conjunction with the SPY. One of the core issues we're having is we're just unable to hold any ground whatsoever. Now you can see here we have the S&P up and we have it running directly with JNK, which is the high yield junk bond fund by Bloomberg, the ETF. Now we've shown this a couple times how this is correlating perfectly when it starts to reverse. And let's just highlight those areas. It's just important for us to kind of review what's going on because this may be able to help us in the future. Right? So what we're always looking for is we're always looking for some kind of pattern. And as we talked about it here, we saw that break. And then after we saw that break, we saw the subsequent fall. And you can see that right here, right after it broke that area, and then how we took out a new low. And we had a couple others of these, and I'm just going to point out another one that I think is just glaring. So, and the reason to show these is not say, look at what's happened, but what you're trying to do is you're trying to do it in such a way so that you can focus on how you can go forward and see this yourself and go through with them, right? So you're trying to figure out how you're going to do this and how you're going to benefit from this. So you want to watch these levels. So if we see correlations like this, where we're breaking on the junk bond market, and that's correlating with new lows, right? And then that correlates with a new low. And then we have this, which just takes out the low. Okay, this is setting us up for a much larger move down, right? Now, whether or not that happens, there's no such thing as 100% correlation. Whether or not that happens, there are two things that we need to take into account for what has just transpired here. Okay, we have this low now below here. Same thing finally followed through on the S&P, right? It took a couple days for it to follow through. But we have this little uptick in the junk bond market. So we just want to watch that. That could be the beginning. We are grossly oversold, being down 9% in 3 days. And you are going to a Fed meeting, and we do like certainty, right? So if we can get to the point where we have some certainty, tomorrow, whether it's 50 basis points or 75 basis points, I'd rather see 75 and rip the Band-Aid off, that this can actually hold this level and then maybe start to base. Maybe. That's the key word. Right now, we don't see any indexes or any reason for that. But we just need to look at precursors. And as we've seen previously this year, you can use this as a precursor. So maybe this can give us a signal. But it's definitely worth being on your radar. This is one thing you're going to want to keep an eye on tomorrow. So this is the 10-year Treasury constant maturity minus the 2-year. So nice way of saying it's the spread between the two bonds. You can see the spread right now is around 6 basis points. What we don't want is we don't want them to be negative, which is what can happen during an inflationary environment, because when that's negative, it can trigger a recession. A matter of fact, these gray areas here since 1980, every single one of these has triggered a recession. And the gray area is that recessionary period in time. So you want to make sure that, so tomorrow after the Fed does what they do, take a look at the 2-year and take a look at the 10-year. And very simply, make sure that the 2-year is not higher than the 10-year. And that'll tell you generally how we are leaning. Of course, you still want to look at your other bonds. You want to look at junk status, you want to look at corporate bonds, and you want to look at the 20-year. So next we should focus on the 10-year, because I think that's really where people need to put their heads. Now, I pointed this out the other day, and I want to go through this. You need to focus on this tomorrow, just like the other two things that we went through. You have to look at the market macroly and not individually tomorrow. It's all one big trade right now, okay? I can't stress that enough. Just remember that, one big trade. It's all going to move in tandem, and it's going to move predicated upon what the bond market does. So I just want to point this out, 125%. So if you were out here in January, right, and you were coming in to this market, that's how much yield has risen. If you were buying a house, your mortgage payment went from the 3s to the 6s, and we haven't even seen what they're going to do tomorrow. My personal hope is they do 75 basis points and rip the Band-Aid off. I'm not sure if they're floating that out there or not. You're seeing some signs out here that we're getting a little overextended. Maybe, but we could stay like that for a while, right? So we have to kind of drill down into this and see where that could take us. Well, geez, that can take us all the way back to, here's 2010, here's 4, okay? Here you are next. This is next support or next resistance, 375. Okay, these are the levels you're looking at, 10, 12-year levels. And we remember what the housing market was back here in 2010, 2011 like. So we're not really seeing that yet, but you're going to need to watch the 10-year tomorrow, and you really should be looking at these. If you see a huge spike in the 10-year, start looking at nail on the short side. Start looking at DRV, which is the bear home builder, on the short side. right? So this would be how you would short it with a bear ETF, okay? And you want to go long that, and then obviously this is which you would short, right? Which is home builders and suppliers, and you can see how that's acting as well. So these are pretty much telegraphing which way that the housing market's going to go, and I think both are good trades. So for exact entries or exits, you're always welcome to take a look at the trading room. There's a link up top here in the right. The last piece of advice I'll leave you with, there are other links to other videos, the candlestick videos in the description, as well as the preview and the button to join the trading room. But go through those that are in that description, because the RSI video's in there, the candlestick videos are in there. I'll link a couple at the end, but I can't link them all. So that's it. Again, if you don't know what to do tomorrow, just stay out of the way until this settles itself down. Trade to win, everyone.